With investing, you always have risk versus reward. How much risk are you willing to take to give you a certain level of income and a return? For a lot of investors, they take risk early in their working years by investing in growth-related investments and shift more to income-producing investments as they near retirement. These could be dividend-paying stocks, preferred stocks, real estate investment trusts, foreign and domestic bonds, just to name a few. Today I'm going to cover a key risk associated with income portfolios by describing the effects that rising interest rates have on bonds. Bonds can sometimes be thought of as more conservative than stocks, and many people utilize bonds to supplement their income at retirement. A bond, as you know, is an IOU issued by a company to the investor, and the company will typically pay dividends monthly, quarterly, semi, or annually. There are some key risks, however, to owning bonds. There may be a sinking fund provision that allows them to retire a certain number of bonds early, and your bond could be one of them. There is credit quality and default risk. There's liquidity risk, which puts into question whether you'd be able to find a buyer if you needed to sell it before it matures. The Federal Reserve has kept interest rates artificially low for some time, and the Fed funds rate actually hit zero in March of 2020. So what is interest rate risk and why is it so important? When interest rates are near zero, logic says they have nowhere to go but up. When interest rates goes up, bond prices fall. That's because the bonds you own now are not worth as much as the newer ones coming out that reflects the higher yield. There's a measurement in each bond that tells you how sensitive your bond is to interest rate changes. This is called bond duration. To give an example of duration, if your bond has a duration of 10 and interest rates increase by 1%, your bond could lose 10% of its value. Longer maturity bonds have a higher duration and shorter maturity bonds have a shorter duration. So be careful buying a bond that has a longer maturity just to get that higher yield, especially if you think rates are rising. One way of diversifying your fixed income is to add different income-paying investments that won't be so affected by rising interest rates. Two options that come to mind are low-duration bonds, or those that have shorter maturities, and the other is the use of loan funds. They are similar to high yield from a credit quality perspective, and both will usually pay higher levels of income than investment-grade bonds. The main difference between high yield and bank loans, however, is that bank loans are collateralized, and they are typically senior debt. Bank loans are also adjustable, which means as rates rise, your income or coupon rises. Because of this, you have an asset class that may actually go up if interest rates rise. I have used loan funds for many years now, but mainly in a rising interest rate environment. I never have a high percentage in this class, but I use it to get the higher yield and to diversify the income portion for my client's portfolio. Consult your investment professional to see if loan funds might be appropriate in your case. Reach out to me and I'd be happy to discuss your income needs and your particular situation. You can visit my website at leejacksonlpl.com. You can email me at lee.jackson@lpl.com or call me at 334-676-2288. I can help develop a tailor-fitted portfolio that's based on your risk that you like to take. Thank you, and I look forward to hearing from you.